Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. It's a great moment of celebration for all of us here at Almus as we complete 11 successful years since inception. My greetings to everyone and especially JK, who has also completed 11 years as he is one of the co-founders of the firm. Now, coming back to markets, if I could quickly summarize what's been up lately, we have the US yields rising, keeping the dollar buoyant. We had lots of data yesterday on the labor market and an important one today called the non-farm payrolls. Yesterday, we also had the Bank of England raising rates by 25 basis. JK, over to you. Take us through what you see in the markets currently.
First of all, thank you, Suraj. And it's been indeed a great journey of 11 years for Almus, and one of satisfaction as we have established ourselves as one of the premier consulting companies in the area of risk management. I take this opportunity to thank all our clients for their support and giving us an opportunity to serve them. My thanks are also due to all our associates for their support and best wishes for the entire Almus team. And back to the markets. Yes, rising bond yields continue to remain the focus as break of each resistance is bringing in more sellers. For many, it is inconceivable that yields are rising in the face of underwhelming economic data, that too when the peak rate in the cycle is not far off or may already be in. The joker in the pack is the US fiscal deficit, which is necessitating much higher borrowings by the Treasury. And it's not the best time to look for raising more money as the market is already long. Rather, it's not the best time to buy the bonds because the market is already long. And assuming for long that the Fed is done with the rate hikes, market has been running long positions in the short as well as in the long tenor. And Fed itself has been, in a way, selling securities because they have been in a quantitative tightening program. So the 30 and the 10-year bond yields hit a new 8-month high of 4.3260 and 4.1980 respectively, as selling continued in the US session. The rising Japanese bond yields also, put the downside for the yields very firm, and with 2-year not moving so much as new issuances are concentrated in the long end, the yield curve has steepened by nearly 50 basis points in the last 5 to 6 weeks. Now, on the economic data, it remained mixed from US. Employment indicators following the strong ADP number, the job openings and the unit labor costs, which have been lower, give some relief to the policymakers. We see the employment and the private component in the manufacturing and the services PMI have also been lower, and that is again giving some comfort to the Dows. ISM services PMI itself had been lower at 52.7 versus 53 expected. On the European side, services PMI has been slightly higher than initial estimates, but indicators like retail sales have been much weaker. And the Euro area PPI for July has shown much faster deceleration, coming at minus 3.4 versus minus 1.6 in June on a year-on-year basis. Now, the European services activity showing the slowdown and the PPI showing faster deceleration, keeps the European yields subdued even as US yields have been rising. Therefore, the differential between Europe and US has widened to an 8-month high, keeping the euro pressured. And so on the yen, of course, the rising yields are supporting some yen strength, but 142 has been holding for now. We have seen in the past week that every time dollar yen has tried to dip and the yields have started to rise faster, the Bank of Japan has come in and indulged in a new fresh bond buying program from the market. So they are trying to ensure stability and avoid any disruptive moves in the market. On the GBP, of course, finally a confirmation of a lower increase in the policy rate by 0.25% versus 0.5% last time. That was well discounted by the market, and that's the reason why we find sterling somewhat recovering after the event. One should not forget that the sterling rates are still headed higher, though at a slower pace, and the policy peak rate is estimated at 5.75% versus 5.5% currently for the US. Therefore, sterling should remain well supported, whereas Eurozone will be perhaps still a question mark on whether there will be a further rate hike or whether there will be a pause or a skip. So overall dollar remains strong, supported by the higher yields, but possibly we are entering into a very quiet day today ahead of the 6 p.m. Release of jobs data from the US. Estimates are for almost unchanged, rise in the non-farm payrolls around 200K, and the unemployment rate to remain at 3.6%. Even the hourly wage earnings are expected at 0.3%, but any major deviation, particularly on the higher side, or better employment numbers will add fuel to the fire as far as yields are concerned. So one should watch out. On the rupee, we continued to weaken yesterday and touched important resistance at 82.80. The central bank was seen offering dollars at those levels, and today we might have a renewed test, but I think ahead of the key event in non-farm payroll, we probably will not break it, and at the same time downside may also remain limited. See, we have new challenges for the rupee because inflows have suddenly dwindled. On the contrary, we are hearing about large outflows, and then we have the oil prices, which have once again bounced yesterday after Saudi Arabia decided to extend their production cut into one more month. So the challenges for the rupee, have suddenly risen and keep it somewhat on the defensive side. It could take some time for the rupee to reverse to the lower side of its range. Of course, if we do break 80 to 85, on a closing basis for the week, we might actually be on a path to much higher test around 83 or even 83.30. But all depends on how the data comes today. Thank you.
Thank you, JK. And whenever we are seeing rupee test 80 to 80, I remember just even a few days back, we had tested a high of 82.76. Now, of course, the focus is on the US bond yields that remain an area of concern as they have been rising consistently, as well as the Japanese yields. They have been slowly inching up, and any sharp moves have caused intervention from the Bank of Japan. Economic data in the US remain mixed. Job openings have been lower. Employment and services PMI has also been lower. ISM services PMI was also a little lower. And when it comes to the Eurozone, the Euro area PPI has shown fast deceleration. So it's all in the bag, and we'll continue monitoring how things go forward. That's it from us today. Have a very good weekend, and we'll see you all on Monday with another round of fresh updates. Thank you so much for listening.